Hi everyone, Sam here from the advice team here at Verse Wealth, and thanks for joining me for the 2026 edition of our budget wrap. Federal budget is here, it's landed overnight, and after weeks of speculation and news headlines around what might be involved, we finally have the details. So in this video, we'll be unpacking what we see as being some of the biggest or most relevant changes that have been announced from the wealth and financial planning perspective. So we're going to look at what has changed and what hasn't changed across four key areas: capital gains and capital gains tax, negative gearing, discretionary trusts or family trusts, as well as some other measures that have been announced around personal taxes and cost of living. And it is worth keeping in mind that it is just an announcement at this point. The changes haven't been legislated yet, and so what ends up being legislated may actually look a little bit different to what's been announced today. So one of the first big changes to unpack has to do with how capital gains are actually calculated for tax purposes. A little bit less generous overall in most cases. So from the 1st of July next year, we're going to see a shift from what's known as the 50% discount method to a new method which is based on inflation indexed over time. So under the current settings, if you make a capital gain on an asset and you held that asset for longer than 12 months, then you're entitled to halve the gain amount and you're assessed on what's left over for tax purposes. Under the new system, there's not going to be a flat 50% discount. Instead, the gain that you've made will be reduced or adjusted for the amount of inflation that's happened during the relevant time period, so that in theory, you're only being taxed on the real or inflation adjusted capital gain. To give you a really simplified example of how that might look, imagine a simple investment that's made for $100. Over a year, you see 8% growth, and then you sell it a year later for $108. Let's assume in that same year, inflation was running at about 3%. So under the current settings, inflation is irrelevant. If you've made an $8 gain and you held it for more than a year, you can discount that gain by 50%, and then you're only taxed on the remaining $4. Under the new method, there isn't a flat 50% discount, but what happens instead is your cost base is adjusted upwards so that the gap is closed between what you paid for it, the cost base, and what you sold it for. So in this case, the gain would be $5, but because there's no discount applied, the tax is applied to $5 at the end. So you can see here in a really simplified example, we do anticipate that a little bit more tax would be collected in these sorts of scenarios, which was the intention with this budget change. The intention here being to dial back some of the concessions available in terms of assets and capital gains, and that's what we're anticipating that we'll see once this comes into effect. It will also make the calculation of taxable gains a bit more nuanced because inflation, of course, changes all the time. In years where inflation is running quite high, it'll make for relatively lower taxable gains. But if inflation is running low, and let's say your investments have had a really good year, then the taxable gain will extend outwards accordingly. One other thing to note here, it is from the 1st of July 2027, so the 50% discount method will apply up until that date. That goes for assets you're already holding or intend to purchase in the near future. Up until this date, the taxable gain will be calculated according to this method. Once the clock ticks over, any gains from that point on top of the value of your asset at this date will be calculated according to this. So disposal of assets in the future may involve some combination of both these two methods to figure out how much tax you actually owe. Another big change announced in this space is the introduction of a minimum 30% tax on capital gains across the board. This is a significant departure from the current settings, whereby the tax treatment of the capital gain really depends on whose hands it's in. If you or the beneficiary is on a low personal tax bracket, let's say they're retired or perhaps a uni student or something like that, capital gains could be taxed fairly favorably, and ultimately they'd be added into your taxable income calculations based on where you're at in terms of the marginal tax brackets in Australia, which quite often could sit under 30%. That's done. From here, you won't be paying any less than 30% on any capital gains in virtually any situation. It appears that one of the motivations for this policy was to reduce the incentives for people to hold on to assets until they're retired, until they reach that point in their life where their marginal tax rate is very low, to reduce the tax payable. From here, it'll just be a flat 30%. So there's less of an incentive to hold on to it for a long period of time. And that may play into the broader messaging we're hearing with the budget around housing availability and freeing up supply and reducing competition for younger Australians trying to get a foothold in the property market. Finally, pre-1985 assets will start accruing taxable gains from 1 July next year. So any assets that have been held since before 1985 are considered CGT free or CGT exempt. From next year, that'll no longer be the case. There won't be tax payable on all of the gains between then and now. But moving ahead, if they're still held beyond 1 July next year, then any gains on top of that, a tax liability will start to accrue for when the time comes to dispose of those assets. So with that in mind, some of the possible exceptions to those rules will be for new builds on the property space. The investor will be able to choose whether or not they take the 50% discount method into the future, or if they decide to apply the indexation method instead. They're welcome to choose whichever is likely to give them a more favorable tax outcome. And this is really just a reflection of the government's priority to improve housing supply as much as possible and try and tilt this budget in favour of younger Australians and those looking to get into the property market. There may be some exceptions carved out for startups and early stage businesses, noting that they do make a fairly vital contribution to the Australian economy, and so wanting to incentivise that and not necessarily penalise it with gigantic capital gains tax bills if someone starts a business and it does well in Australia. There may also be a carve out here for income support recipients. For example, if you're receiving the age pension, then these new rules may not apply to you at that point in time. What hasn't changed? The main residence exemption for CGT. As before, the family home, regardless of any gain that's realised upon selling the family home, that's not taxable. We're also not expecting any changes to the CGT discount inside superannuation, whereby 1/3 is the flat discount applied for any capital gains realised for an asset held longer than 12 months. Next up, we've got negative gearing. And when we say negative gearing, what we're really talking about is the policy setting in Australia whereby net losses from an investment, for example, a property, if the running costs, including interest payable on the loan and all of the other costs associated with that asset are higher than the income generated and there's a loss position, in Australia, negative gearing is basically the ability to use that to offset other income, most commonly wages. So from the 1st of July 2027, we're going to see that wound back a little bit. It's not going to be possible any longer for new investments made in established residential property. Negative gearing in its current unrestricted form is only going to be possible for new builds. Bear in mind here, we are talking about decisions being made here for new investment property purchases, not properties that have already been purchased. Between now and the 1st of July next year, if you go ahead and purchase an investment property, let's say it's an established residential property, like a house or a townhouse or unit, you will be able to negatively gear up until the 1st of July, but from that point, you won't be able to unless you've purchased a brand new build as your investment. While you won't be able to negatively gear in the traditional sense, you will be able to carry forward the net rental losses. So instead of being able to use it to bring down your wage taxable income, for example, in any given financial year, you'll bank it. And then in future, let's say your investment property becomes positively geared at one point in the future, or maybe you go to sell it and you trigger a capital gain, you'll be able to use those losses to offset that in future. So it does help ease the burden in future, but it doesn't help in terms of the year-to-year tax position and being able to utilize that to get a healthy tax refund as a byproduct of owning a negatively geared investment. In terms of likely exceptions, properties inside super should be exempt from these changes. We're also not expecting these changes to be applied to commercial property or real estate investment trusts, many of which are available on the ASX. Reason being that this policy seems to be fairly and squarely targeting residential property only, making it less attractive for investors to buy residential property, and therefore, in theory, making it easier for first home buyers to show up to an auction, for example, and have a bit less competition to buy the home for themselves. So commercial property and property that you typically find wrapped up in managed funds and ETFs and that sort of thing with a property tilt shouldn't impact what goes on there. There's also a question mark at the moment around the main residence. So given that these changes are applying to properties acquired from here on out, if, for example, a main residence was owned or has been owned for a number of years prior to these changes and subsequently converted into a rental property, not sure how that'll be treated just yet. So we'll have to stay tuned for more clarity on that from the government. Just as importantly, there are a few things that we know haven't changed at this point, and that is existing investment properties. So if you've owned your investment property before the budget announcements last night, that will be grandfathered, which effectively means you'll be able to continue negatively gearing that for as long as you want until you sell. We're also not expecting any changes to negative gearing when it comes to other asset classes. Again, targeting residential property, which means that if an investment loan is taken out to purchase shares or ETFs or managed funds, for example, and your investments in those assets are negatively geared, no changes. You should be able to claim the full deduction against your personal income, wages, and that sort of thing as well. Moving on to family trusts. And there's been a big change announced in this space to kick in from the 1st of July 2028. And that is a minimum 30% tax on all distributions. That includes income distributions as well as any capital gains that are triggered inside the trust in any given year. It extends to both individual and corporate beneficiaries, also known as bucket companies. In a significant departure from how things were previously, that 30% tax is actually going to be paid by the trustee. We're not going to see the flow through of tax liabilities to land solely in the hands of the beneficiary. The trustee is going to be obligated to actually withhold that 30% tax from distributions before they're made to the beneficiaries. In order to allow for that or account for that, the trustee will pay the 30% obligation and the individuals will get a non-refundable credit. So effectively means that if an individual is on a higher tax bracket than 30% or their marginal tax treatment will be higher than 30%, they'll get a non-refundable credit to offset the difference and effectively leave them with the same end result. We're not sure how this will land for bucket companies. It's still to be confirmed, but there is a chance that bucket companies won't actually be entitled to that non-refundable credit. And because of the nature of that credit being non-refundable, if you are making distributions to a beneficiary, an individual beneficiary on a really low tax rate, it's going to be taxed at 30% on the way through. The individual doesn't get to claim back the difference effectively. So in this case, it gives effect to the minimum 30% tax. You won't be able to have any beneficiary paying any less tax than that at the end of the day, regardless of what their individual or personal, let's say, tax rate is in that financial year. In terms of exceptions to those rules, other trust types, as at the current guidance, we're not expecting these changes to be applied to any other type of trust, so unit trusts, disability trusts, testamentary, that sort of thing. The government has also flagged that an exception may be made for primary production income, for example, farm income. The government have also flagged that there'll be some rollover relief for business owners in particular who, as a result of these changes, wish to restructure their affairs, let's say move away from a discretionary trust structure into something else. There may be some concessions or benefits or relief given to help people make that change in certain circumstances, the details which are still to be firmed up. In terms of what hasn't changed here, tax payable for high income beneficiaries, which basically means for individual beneficiaries, let's say if you're receiving distributions from a trust and you're already in the highest or the second highest marginal tax bracket, it'll be the same end outcome. It'll just be a worse outcome if you're a lower income earner receiving a distribution through a trust, because you won't be paying anything less than 30% in any case. Finally, just a few notes on what we can expect in terms of tax cuts or tax benefits on a more direct individual level. So from the 1st of July 2026, there's going to be a 1,000 instant tax deduction, which is basically no receipts or admin needed. If you've got expenses to claim them, and you'll get the deduction, no questions asked. From the following financial year, we've seen a $250 new tax offset introduced, the WATO, or Working Australian Tax Offset. And that's going to be targeted at people who specifically get their income from employment, whether they are employed by someone else or if they're self-employed as a sole trader, you'll be eligible for that offset, which will be applied at tax time. So you won't actually see the benefits from that until after that tax year. So let's say, July 2028 at the earliest. Finally, from the 1st of July 2029, the government has flagged that they're going to start winding back tax benefits for electric vehicles. This has particular relevance to novated leasing, as it forms part of the fringe benefit tax regime, which is where the changes are being made. And so we are anticipating that while the exact details remain to be seen, it's likely that electric vehicles, while they've intentionally been made very attractive from a tax point of view, they'll continue to be attractive, but perhaps just less so. And we may see that wound back further over time. Obviously, 3 years is a long time away, so anything could happen between now and then with that particular policy. And that brings us to the end of our 2026 budget wrap. So we'll be watching this carefully over the coming months as these proposed changes are debated in Parliament, and we'll see what comes into effect starting this year. Thanks for watching, and we'll see you next year.